What do you think that the new year 2024 will bring for capital markets? Top or flop? We are actually quite optimistic for the most important driving factors. For instance, inflation, the huge topic of the last years, but it has come down tremendously this year, 23, to levels close to the target of the ECB. European inflation on average is currently at 2.4%, so not far away from the target of 2.0%. And we are quite optimistic that this lower level of inflation will also continue well and persist well into next year. This makes us also very important for the next driving factor, interest rates. They are currently at very high levels, as you see in the chart, at 4%, higher than in previous interest rate peaks. And now with inflation coming down, also with the economy very weak, the euro area is currently probably in recession, which will well continue into the next months. The ECB has room, first, not to increase rates higher, and nobody expects them currently to go further up with interest rates, but this also opens room for lower interest rates starting in 2024. Whether that's in spring, as the market currently expects, or later in autumn, does not really matter. The next big move in interest rates, in our view, will be to the downside. A long-term average interest rate in normal times was around 2%. That's a medium-term target that we should hit. This again is very important for bond markets. Bond prices had suffered last year from the rising interest rates. If you agree with us that interest rates will come down in the medium term, this should prop up bond prices again. And for instance, in a bond fund, in our view, should make for a quite nice, decent performance over the next years. Last but not least, equity markets. You might think the outlook is bleak because the economy is weak currently, especially in the euro area. We're probably in recession. The output in the euro area has already been shrinking in the third quarter. Probably this continues now in the fourth quarter. So what does this mean for the equity market? Well, the point is, usually, at least we, would try to increase equity exposure when you are close to the economic low. And you see here in the line, this line is the strength of the German economy in this case, which is also the bellwether for the euro area. And we are currently pretty low here also in this indicator. Doesn't surprise, we are in a recession currently. The point is, I've just labeled some of these events when we were at low points in this economic indicator, in the economic cycle in Germany, and just look it up with an equity chart what the performance was afterwards. So if you would agree with us that we are currently closer to the lower point of the economic cycle, and maybe we hit the low only in the first half next year, but that in the following 1, 2, 3 years, then economic recovery will ensue, well, then in our view, this is a strong reason, of course, now to use this weakness on equity markets in a longer context to increase equity exposure. And this is especially true as most equity markets currently also from valuation point of view are actually quite cheap. The euro area average, for instance, for the equity market is as cheap as it was at the low point of the corona recession. Can it get cheaper? Sure, in the short term. In the medium term, this has always been good buying points. So to sum it up, we are quite optimistic for next year. I hope this also improves your mood towards 2024. In this case, don't forget to like us, subscribe, hit the bell, etc., etc. And we wish you all the best for 2024.